Okay, today we're talking about accounting for current liabilities. Okay, we talked a little about current liability, but today we want to talk about it in more detail. It's like current and long-term liabilities. Okay, now again, liability, remember, it's all your company's debts and obligation. Pretty much like I said, something happened in the past, an obligation. Now we have to make some kind of sacrifice. Okay, and again, the most 9 out of 10 times the way you pay it is with, of course, cash. You got to make a payment or you provide a service. Again, we got to classify liability. Remember, current liability would be what's due within a year or less, so the company's operating cycle, whichever is longer. Now, long-term liability is due after 1 year, after the operating cycle, whichever is longer. A lot of your long-term debt, maybe you signed a loan, maybe you bought something on the long term. Okay, now, again, current long-term liability, again, they're obviously due within 1 year. The company's operating cycle, or long-term, obviously due after 1 year, whichever is longer. We see some companies, obviously the big portion of their liabilities could be current or long-term. Again, we look at sometimes uncertainty of liability, uncertainty whom to pay, uncertainty when to pay, uncertainty how. Again, sometimes I'm talking about some liabilities we know exactly how much to pay and when to pay. Other ones we're going to have some uncertainty. Again, let's talk about identify and describe known current liabilities. These liabilities we know exactly how much they're going to be and exactly when to pay. Again, these are some of the liabilities we talked about before. We got accounts payable, sales tax payable, and so on. Now, all these liabilities, we know exactly how much we owe, what we owe, and the due date. Accounts payable, we talked about. Accounts payable are all your monthly transactions. Again, they're incurred in 1 month, let's say in June, and you'll pay them in July. Okay, most companies start, I think they buy on credit. And again, you have sales tax, earned revenue, and so on. And sales tax payable, remember, it's a liability of the company. Okay, and again here, sales tax payable says it's a liability because remember, it's not revenue of the company. All they're doing is collecting it from us, the consumers, and giving it to the city and state governments. And again here, it says Home Depot sold materials. Again, remember every time you pay an extra 5% here, remember the customer paid $6,000 sale, they had to pay an extra $300 in sales tax. The extra $300 becomes a liability because now Home Depot, they own this. Okay, they owe this to the government. All they can do is take it from us, the consumer, hold on to it, and when come due date, they'll pay the sales tax. Again, another thing we talk about is unearned revenue. Unearned revenue is when company receives payment before fulfilling the obligation. A very popular thing is a concert, for example. In this example, we talk about Rihanna. Rihanna sold $5 million in tickets for 8 concerts. Now again, Rihanna got the money up front. Now every time she has a concert, she owes less and less. Okay, it says, okay, now she owes 8 performances. Okay, after each performance, she owes 1 less. And we see, I take the $5 million, divided by 8, so each time it's going down by $625,000. That means she owes that less. Now initially, if you notice, you debit cash to increase cash, and you credit liability to increase it because now Rihanna has $5 million of obligations. After she performs the concert, you want debit unearned revenue because it's going down. The liability has been decreased. She owes 1 less. And ticket revenue you can actually put down as revenue because you actually earned it. You want to credit that account. Okay, now let's talk about some account for short-term notes payable. Again, it says a specific amount to pay. Again, most short-term notes payable, again, like I said, is within a year of the operating cycle, whichever is longer. Again, like I said, it's a written promise to pay, a specific date, whichever is longer. Again, a lot of times it might be, you want to talk about you replace your accounts payable here. Okay? You say, all right, I'm replacing my accounts payable now with the notes payable because, again, the big difference now is, all right, you want an extension. They say, okay, no problem, extension. But in the meantime, now you pay 12% interest. So the accounts payable is off your books. Now, if you notice you owe $600, you want to credit cash, you paid cash $600, but now you have a notes payable. You have a liability to McGraw here. Now Brady plays a note plus interest. How's it look on your books? First of all, you want to get rid of the notes payable off your books. It's gone. It's worth $500. You're always going back to the original principal amount. Okay, again, interest expense here. You want to, obviously now it's an expense you incurred. You got that extra time to pay the note. You got an extra 60 days. In the meantime, you got to pay $10 extra of interest. You want to credit cash for the entire amount you paid, note plus principal, because cash is going down, and how much cash you paid to pay off your obligation there. Now, as you borrow money from the bank. Now, when you first get money from the bank, the cash notes payable both are being increased. The assets being increased with debit, the payables being increased with credit. So now it's owed. Now remember, if you notice initially there's no interest because interest hasn't had time to accrue. Now when it comes time to pay for the note, you want debit the note's payable liability. Because it's going down now for the original amount. Okay, it's going down now. Now the interest expense, how much interest did you pay? You paid $40 of interest. Then cash, you always want to credit that cash to decrease it, because remember, that includes principal plus interest. And again here, when note extends over a period of time, again, sometimes during a period you might have to accrue some interest here. Here it says, okay, you got December 16th, but you're not going to pay if you notice here until February. So you got to accrue how much interest has accrued at year end, at December 31st, 2017. And we said it is for 60 days. It accrued for 15 days. Take the principal, $2,000, times the interest times 15 divided by 360. Remember, interest is always based on 1 year, even if it's for 60 days, as we see. Yes, we see here, again, kind of like we did in previous chapters. You want to, obviously, debit the expense to increase and credit the payable to increase. They're both being increased. So now this tells me you had $10 of interest incurred, and now you owe $10 of interest. Now it comes time, now, in February, you pay everything. It means you pay all the principal that you owed plus all the interest. And if you notice here, now the $30 of interest, that's for the remaining interest. That's for the 45 days. The payable that you owed, you're paying that back. Plus you want to debit the notes payable to get off your books now is being decreased. And then you want to credit cash to decrease it because now it's all being paid off. Again, so example some we talked about. Again, we talked about every time you have a sales tax, you want to credit that to increase it. Sales tax payable. Again, obviously record the cost. And then come time when you start to remove the sales tax. That means you give it to the government, maybe city, maybe state. So again, you want to debit the liability, get off your books, and credit cash to decrease cash. Okay, advanced ticket sales. Remember, when you first get cash in advance for ticket sales, you want to increase cash for the debit. You want to credit unearned revenue because now it means you owe it. And of course, when you when you start earning it, you want to decrease the unearned and credit the ticket revenue because you've actually earned it. And again, you were talking about earlier what happens with the notes. When you first get a note, cash notes payable. Accrue the interest from November 25th to December 31. That's 36 days you accrue for interest. And the last part, we want to pay it all back. Remember, we got the payable, the interest expense for that current year portion, the notes payable, and the cash. Now, talk about employee payroll deductions. Remember, payroll deductions and some of your liabilities you have with payroll. Remember, payroll is the whole process. Remember, employers incur expenses too and liabilities just from having employees. Your gross pay is what you earn. You make $10 an hour. Well, you're earning $10. Now, you're not going to get $10 because you have a lot of deductions from federal, state, some voluntary deductions, FICA taxes, Medicare, Social Security. Then your net pay. That's the amount you're actually going to receive on your check. That's the amount going to be in your direct deposit. Now, these taxes right here, it's mandatory. It means everyone has to pay them in all 50 states. FICA, again, it's the Federal Insurance Contribution Act. As for Social Security. Okay, you got part for Social Security and another part for Medicare. Again, what employers would do is they withheld these taxes from your paycheck and they submit it to the IRS. Again, federal income tax and state income tax. Remember, federal income tax, that's for all states. State and local, that one depends. Most states have state income taxes. There are a few states, Texas, Florida, there is no state income tax. This one depends on how much the employee earns, their marital status, if they have any dependents. Now, these are voluntary deductions. Remember, the employee doesn't have to participate in these deductions. The employer will ask you day one, would you like to participate? Would you like to be in such as? Would you like to be part of the union? 401ks, IRAs, insurance, like to give to charity. Again, the employer, what they do is they're going to withhold from your paycheck, and they can submit it to the insurance company, savings company, and so on. And how do you record deductions? Remember, your salary expense, that's going to be your gross amount. The employee earned $2,000. Now, they're not going to receive $2,000 because they got to take out certain things, such as the FICA, they're all payables, federal income tax, insurance. The salary is payable, that's the amount you're actually going to receive. That's the amount you're actually going to pay the employee. So the employer earned $2,000, except you're only going to receive $1,524 because these are all deductions. Okay, let's see how I'm going to record that. Again, go back to it. So yeah, we talked about employees pay. Remember, employer, all the amount the employee pays to FICA, for Social Security, Medicare taxes, they have to match that 100%. And they have to pay federal unemployment taxes and state unemployment taxes on each employee. FUTA and SUTA, they call it. So on top of paying your employees, again, remember, they have to match all the amount the employee pays into FICA, and then on top of it, they got to pay for federal and state unemployment taxes. And this is the employer. It's a payroll tax expense. So everything the employee paid in FICA, they're paying it too. And then, state employment taxes and federal employment taxes, those are calculated for separately. And this is the amount the employee has to pay, the employer. Remember, to control payroll, make sure certain activities will be monitored from hiring, preparation. Remember, there's a lot of sensitive information in there. Social Security numbers, your phone number, addresses. A lot of information there that has to be kept private, kept secure. Again, look at multiple period liabilities talked about, unearned revenues, notes payable. Again, give an example one. You're going to sales salary to office salaries. And all the deductions they have. Their payroll tax expenses. Now, some liabilities to talk about, we're going to have to estimate them. Probably one of those biggest ones to talk about from warranties and bonuses. Estimated liability, again, it's a known obligation. We know we have an obligation, but in the meantime, we don't know the exact amount. All we're going to do is estimate it. Such as health and pension benefits. You can place them equal to $8,000, again, and 10%. Now, these are your benefits. Maybe the employer will use it, maybe they won't use it. That's why you want to debit the expense to increase it and credit your payables. Because now it says you owe it. They might use all of it, might use none of it. Most important thing is, though, it becomes a liability. Same with vacation. Remember, a lot of employees, what they do is they accrue vacation over time. Again, debit the expense to increase it and credit the payable to increase that. Or bonus plan. Now, warranty is a little bit different. Warranty is like when you buy a car, some appliances. The customer might use all of it, they might use none of it. It depends, really. So again here, we say, okay, dealer says $16,000. You have to estimate this. Okay, we estimate 4% of selling price. Take 4% of that. So we know warranty expense, you want to increase the expense, increase the liability, $640. Now, the customer returns the cars for repairs. Or the liability is going down. Remember, they're only going to cover $640. So now the liability went down by $200. And came from parts, you want to decrease the parts, or if you had to pay cash. Again, so we just talked about, the weekly vacation benefits they have to. Remember, your employees sometimes they have a policy if you use it, so if you don't use it, you lose it, your vacation. Employee bonuses here. So now again, when employees pay the bonus, again, debit the payable to get decrease in credit cash. To also decrease because now you got to pay cash out. Back to your warranties. Obviously, you made a cash sale. Now you have a warranty expense here, $20 worth. And of course, they use $15 of it. A contingent liability, like I said, it's contingent. It's possible. It might happen. It might not happen. It depends on a lot of things. Okay, now again, the question comes, should we not record it? If it's probably going to happen and we can estimate it, yes, you record the liability, definitely. A lot of things, sometimes you're in the middle of a lawsuit or possible, you're worried about certain things happening. If it's probable, but it's not, you can't really estimate how much it's going to be. You just make a disclosure in the footnotes. Then it's possible. Now, if it's a remote chance, 1 in a million chance, it's like, don't even worry about that. No disclosure needed at all. Again, you're talking about any legal claims, any debt guarantees. If you guarantee something, those would be contingent liabilities we account for. Again, here, company estimates the loss could result damage $500,000. Again, not probable loss. Again, here, take into account certain things. Or environmental damage, but in the case of $900,000, it says here high probability of losing the case. So again, here, contingent expense, contingent liability. It says, okay, we're gonna probably have to pay out all this money because, well, it's high probability we're probably gonna lose. And, certain ratios here, time and interest earned. Here it says, all right, can you pay back your interest, and how many times can you pay it back? And different payroll procedures here we talk about here. Again, different reports here, records here we need to keep track of. Any corporate income taxes. All right, class. Let me know if you have any questions. All right. Thank you. Bye.